This is the current federal tax developments for the week of December 19th, 2022. Current federal tax developments are brought to you by your state society of CPAs and by Kaplan Financial Education. This, we're going to look at some of the things that happened in the area of federal taxes. And we'll start by looking at a rather long memorandum the IRS issued that related to a marketed program that's being aimed at law firms that seeks to defer recognition of legal fees for 10 years, at least in the case they were discussing. So we'll talk about the IRS's view on that program. As you may suspect, it was not terribly positive, but also why and what the differences are and what the issues are. We're also going to talk about the fact that the IRS has apparently now finally given up on Congress going back and changing Section 174 to allow immediate expensing before the end of the year, as they have released the official automatic change of accounting method procedure that will allow taxpayers filing the returns for tax year 2022 to be able to make the change required by law to amortize their research and experimental expenditures over 5 years if performed in the U.S., over 15 years if performed outside the U.S. That change of method is required on the upcoming returns, and there are some special rules that are going to come into play along with that. And we'll talk a little bit about what's in that area. And finally, the IRS released a reminder this week that, in case it slipped your mind, the second half of the payment for deferred employer FICA and deferred self-employment tax, one half of that from 2020, that was a COVID-19 relief provision. That second payment is due coming up here shortly. And what I want to remind you is there are some nasty penalties if you don't get that paid on time. So with that, let's start with this memorandum from the IRS. This is Advanced Memorandum 2022-007. It came out on December the 16th. Now, as I say, this is a relatively long memorandum from the IRS, and it looks at a program that the memo says is being marketed to law firms that claims it can allow the law firm to delay, at least in the case it was raised in this particular memo, for 10 years, the recognition of legal fees. And they're basing this on a case that came from the 1990s, which is the case of Childs versus Commissioner, 103 TC number 36. That particular case involved a law firm that was getting basically paid by the defendant's attorney their share of the law fee. They had a contingent fee, so the insurance company was paying their client, and then also they were paying the law firm, and it was on a structured settlement setup. And basically, the law firm was able to recognize that income not at the time the lawsuit was completed, when the IRS tried to argue they had to recognize it, but rather they were allowed to recognize that fee only as they received it. They were a cash basis taxpayer. Now, we're going to talk about why the IRS says, Childs basically doesn't really work for the setup we have here. And one suspicion I have for why maybe it doesn't work is because Childs has been known about for a long time, but amazingly, it appears just now somebody has, decided to do this structure. And I think a lot of people, myself included, see some of the same flaws the IRS sees with this structure and why it's not the same as the Childs case. I also think the Childs case, as we'll discuss a little bit more, is also a case of the facts in Child. It worked to the taxpayers or to the law firm's favor because they had the good luck that the insurer in question chose Executive Life as the company to pay off the annuity. If you don't recall, in the 1990s, Executive Life, they failed. It was a major insurance company failure, and this annuity was not going to be paid out in full. And so we got back to the insurer had to make up the difference. And that liability from the payer, I think, is crucial. And the fact it really had happened by the time that this case got in front of the court, I think had more than a slight influence on the ultimate decision of the court. Like it or not, judges do look at the situation. And, while before Executive Life, you might have thought, oh, well, there's no chance whatsoever. That's perfectly secured. No problem. And suddenly well, it wasn't. So then all of a sudden it was, we got a decision, which Might not have happened had executive life not have happened, but that's open. I'm sure theoretically the court would claim no, it would have been decided that way anyway. Well, we'll see. Executive life certainly made the decision easier to explain to parties who might have otherwise wondered about it. Now, in this particular case, we have a law firm who had negotiated a settlement agreement for a client in a physical injury case. Now, prior to actually signing the agreement, but basically after everything was done but the shouting and the final signatures, the law firm entered into an agreement with this third party who says, hey, we can make sure you guys don't need to pay taxes on this. I believe the actual fee was $450,000 was their share of the award. You don't need to pay tax on $450,000 this year. We can defer it, and we can not only defer it, but we can invest the funds for you and have those funds grow and eventually pay you out at the end. So you'll be able to have those funds, you'll have them invested, and they'll grow. You can even borrow against those funds. And we'll talk about that too, which, by the way, the law firm actually did in this case. In the event, they signed that agreement, and they basically, when the final payment came, the insurance company that was making the payment on behalf of the plaintiff, uh, you know, in essence, they had them divide the payout between the amount that would go to their client that went into the trust account for the law firm, and then the rest of it, the $450,000 that represented their share of the award, that would be their fees. They had that sent off to this third party. Now, with this third party, they had an agreement with them that they would be paid these fees after 10 years. So basically, it would be 10 years from the time they signed the agreement. They signed it in 2021, so they would receive this payout in 2031, which would be the $450,000 plus investment earnings. And during that time, the law firm would be able to strongly suggest, to this third party where those funds should be invested. And the third party would obviously take a percentage of the funds off the top. Eventually, they'd charge a fee for doing this. But the argument was that this would allow them to magically be able to defer this recognition of income for 10 years. Now, I think a key fact here that's mentioned briefly in the agreement, but the only reason why the client would be willing to do this is because, this being a physical injury case, Section 104A2 of the Internal Revenue Code meant the client was not going to pay tax on this award. And that's important because, in essence, these legal fees, would be considered to be income to the client. And there could be a problem if we're going to say the pickup for income gets deferred, the payment could get deferred. And there could be problems if these would be above the line deductible legal fees, which, depending upon the fact pattern, is, I guess, still possible, that, the plaintiff, or I should say, their client might not be so thrilled of having to pick it all up as income currently, but not being able to get the deduction until years later. Yeah, that might not have been fun. So anyway, I thought it was an interesting fact that we did have that case, or just mentioned in passing. Now, as I said, this money went in, $450,000 went into this account on July 1st of 2021. And on August 1st of 21, the law firm borrowed $200,000 out of that account. So the third party gave them $200,000 loan. Now, it was a loan with a stated interest rate, and the entire balance and the interest was due in 5 years. However, the note said that if they didn't pay back the note, they had a right to just offset it against that payment and take it out of the funds being currently invested. So effectively, a month later, they had $200,000. And since it was an investment of the fund, and the fund apparently was going to just credit this interest to the taxpayer, in many ways, it became just kind of a non-event. They had their $200,000 today, and if they don't put it back in 5 years with the interest, then all that's going to happen is they're just going to never have effectively invested the $200,000, and they'll have the other $250 that'll come out after the 10 years. Presumably, I would think in that case they would pick up the $200,000 at the 5th year when there's the offset. But who knows? Maybe according to the way the firm views this, or the third party viewed this, we could go ahead and just wait till year 10 anyway. Not quite sure how that one would have worked. Now, here's a key issue. In the child's case, as I mentioned, the insurer in this case basically agreed to pay the fee over time in a structured settlement. Now, what the insurer did was they bought an annuity to pay it out over time. So they went to Executive Life, and actually there were two insurance companies, one of which used Executive Life, the other one didn't. But let's talk about the one with Executive Life. So they went out and they bought this annuity to fulfill their obligations under this structured settlement payout. So fine, they got that in there. But the issue in this case was the insurance company, the insurance company who was paying, so the party that was liable to pay, was in full control of the annuity contract, owned it. The law firm had no right to reassign it or change it or anything of that sort. Okay, that would be the background in that case. Now, the other hitch was, since the insurer picked the insurance company and was in charge of it and had the right to do whatever they wanted with that contract, they were just under obligation to get these payouts made on the appropriate dates in the future. They remain liable if the insurance company didn't perform. Hint: Executive Life wouldn't totally perform. Then they had to make up any differences, which obviously in this case they did, because with Executive Life going under in the 90s, in essence, they didn't get a full payout of the annuity contract equal to what they had been promised. So because of that, the insurance company had to make up the differential, because all they were under obligation to pay X dollars to the attorney, and I suppose in this case their client, over this time frame. In this case, the tax court said, look, that payout scheme, it's fully basically a deferred payout. And this deferred payout is fine because it's being paid over the time period that was agreed in the agreement. The law firm never had, control of this. All they had was the outfit that was going to pay. It said, we're going to pay over this time frame. Now, this payout was subject to the claims of the creditors, at least potentially, of that insurance company. If they had, if they'd failed, if they had issues, they went bankrupt, there is some risk of what you'll be paid out. So it is available to the claims of the creditors of the party that owes you the payment, right? And that turns out to be pretty significant, I think, in this case. Why the tax court found that, okay, it was being delayed out. Now, the IRS attacks this marketed program that's shown up here in 2021, and we're sitting here in 22 now looking at, for various reasons. Let's talk about their attacks. The first attack they had was claiming that this represented an anticipatory assignment of income. And interestingly enough, one of the things they did, and I loved it in the memo, is, if you remember, we had a case called Banks that went to the U.S. Supreme Court that decided whether, if you had a lawsuit award, your contingent fee case, you have a lawsuit award. So the attorney is going to get 1/3 of the award, and you're awarded $1.5 million, so the attorney is going to get $500,000. Now, the question became, was that $500,000, which was effectively assigned to the attorney, he had an absolute right in 1/3 of your award, was that really taxable to you as the plaintiff in the lawsuit, or was it really taxable to the attorney only? Obviously, the attorney's going to pay tax on either way. So the question is, was it taxable to the attorney? And the key problem, obviously, is if you have $1.5 million of income, and back in the old days, back prior to TCJA, you might have gotten a deduction of about $500,000, but in many cases, it would have been a miscellaneous itemized deduction, which would have meant AMT would have absolutely wiped out any benefit. So you would essentially pay tax on $1.5 million, only having $1 million in your pocket. Obviously, that caused us some tax problems. Now, what the court said was, this is really similar to the bank situation in many ways. You're telling me you don't need to pay tax on it, at least not right now, because you don't get the money. And they're saying, no, just like in banks, the plaintiff, who's the person that has a right to $1.5 million, right, the damage of $1.5 million, they, elected, in order to, have the lawsuit go forward, they elected to say, attorney, we'll let you take 1/3 of this, as long as you do the case, and you'll take 1/3 of whatever you win. They said, well, this they thought was very similar. Just as the client had ownership of those entire rights to the proceeds, the law firm had the entire rights to the fee. And the fact that they assigned it to a third party was similar to the client assigning the legal fees, the amount of the award necessary to pay legal fees, to the third party who was their attorney in that case. So they said, first thing, they think based on banks, this would be taxable to the law firm immediately, regardless of the fact it's going to go park for 10 years off in this other third party. And they said, second, the other key thing was that on a more general review of anticipatory assignment of income, the law firm during this entire claim effectively retained full control of the asset. The liability of the defendant slash insurer, actually it probably was, whether it was the client, defendant, or insurer, we don't care which one, but the liability of that party was extinguished as soon as they transferred the funds to this third party selected by the law firm. The law firm had the full rights effectively to control investments. The law firm had the right to borrow funds out of this thing. In essence, the law firm had full control over the asset. And the mere fact that they chose to have that asset go to this third party does not mean somehow magically they don't have income just because they never touched the cash. They did a direct assignment over, but just as if I said, well, instead of that $500,000, let's say lawsuit award, why don't you put that $500,000 into this closing for this building I'm buying? It's like, well, that's going to be $500,000 of income. That doesn't matter, you didn't touch the cash. And they would say it's the same thing here. But they also went back and argued that the economic benefit doctrine, a broader doctrine of the courts, also covered. They noted transfer of the assets to the law firm, right? They selected a third party to put the award beyond the reach of the creditors of the original payor. And they said it's not clear the way the law would look at this. Is the payor here their client? Is the payor here the plaintiff in the lawsuit? Is the payor the insurance company that's going to actually pay on behalf of the plaintiff, not plaintiff or state, but defendant? In this case, who is the client? But the court said it's really doesn't matter that much because the party that you're going to tell me, oh, it's at risk because their creditors could get a hold of this stuff, we might never see it, is the third party who clearly was not the party under contract with the insurance company. I should say under contract with the attorney, where the legal fees are going to be paid. The attorney did no services for this third party. This third party only got in the mix because the insurance company said, okay, client, this part of the award that is mine, we're just going to send it directly to this other company, right? That's how it worked. So because they have that, they said the economic benefit went to the law firm who had control enough to control getting the asset over to the other company. And so because of that, they said it's going to be taxable. And they also noticed that the Child's case never did address the economic benefits doctrine. It wasn't raised in that case. They're saying, so regardless, even if you were like Child's in the other ways, we're going to say the economic benefits doctrine in this case would cause it to be taxable. Finally, what the Child's case was decided on, Section 83, they said that's going to make it taxable here too. They said what we have here is fundamentally a funded promise to pay by whoever the payor is. And again, the IRS concludes it doesn't matter if you say the payor is the defendant, if the payor is the attorney's client, or if the payor is the insurance company that's paying off on behalf of the defendant. Whichever one they are, they're not the third party, right? So they basically took $450,000 and set that aside outside of basically any claims of their creditors. They set it off to this third party, and the creditors of any of those three could not attach that $450,000 of assets once the payment was made. And noted, since the service was performed for the client, the transfer of portion award to the third party created a funded promise to pay. It was not subject to claims against the client, or in the alternative, if you want to view the insurer, which they kind of did in the Child's case as the party paying, basically, or basically the party who was like the client treated as a payor here, or even you want to take a look at the plaintiff in that realm, it doesn't matter. They didn't do any services for the third-party operation. Therefore, that meant this was a funded promise to pay, unlike Child's, where it was an unfunded promise. All we had was the insurance company saying, hey, we're going to make sure these payments come to you at this day. But they did not. Yes, they may have bought this annuity, but it was put into a rabbi trust, as I understand, remember the whole issue in that case, effectively like a rabbi trust. And essentially, the law, or I should say, the law firm in the child's case had no control. They were just waiting for the payout. And the fact the insurance company chose to try to, reduce their risk by buying this policy from the wrong company, as it turned out, was just, hey, it's what they did. It was their choice. It was not the law firm's. And finally, this I thought was a unique attack. They said, okay, let's assume somehow that you convince a court that this is a deferred compensation arrangement, unfunded deferred compensation arrangement. They said, well, here's a neat thing. Back in the early 90s, 409 Cap A did not exist. And 409 Cap A imposes some very strict rules on non-qualified deferred compensation arrangements between a service provider and the service recipient. Okay, or various parties. If you have unfunded deferred comp, there's going to be an issue. And as they point out, if 409 Cap A applies, this is going to be a far worse result for the taxpayer. In essence, kind of a be careful what you wish for result for the taxpayer in this case. The third part, now you might say, wait, but I remember 409 Cap A, it applies to employees, but these guys were contractors. It's like, we're a CPA firm, we're doing work for a client, right? If the client doesn't pay us for 2 years, we're cash basis, for whatever reason, and we even agree to that, you can pay us in 2 years. I mean, we're just going to pick it up 2 years from now, right? Yeah, okay, good. And 409 Cap A is not a problem. Okay. But here's the catch, because there is an exception in the regulations called the third-party contractor rule. But here's the catch. That rule only applies to a plan, a deferred compensation plan, in the view of the IRS, they said, actually, in the actual reg, it says this, a plan that is between the service recipient and the service provider. The IRS says, wait, this case, now, that's not what we have here. Because in this case, you have a contract between a third party who received no services from you and you, the service provider. As such, if it is a deferred compensation arrangement based on those services, well, tough luck. It's like it's covered by 409 Cap A. And if it's covered by 409 Cap A and you violate Cap A, first thing is the entire balance is immediately taxable to the extent it had already been taxable. So it'd come into income immediately. And number two, there'll be a 20% additional penalty imposed on that amount you receive. That makes you much worse off, right? So we're going to take a look at that. And they're saying that's what would happen here. They say because this arrangement, once it's covered by 409 Cap A, violates two different rules. First, it fails what's called the initial election timing requirement. The election has to be made before services are performed. Okay? You can't apply this to services that have already been performed. And they said, look, this wasn't signed until just the instant before we're going to sign off on the settlement agreement. The services had effectively all been completed before this document even they began thinking about it. And that means that you couldn't make a deferred compensation election for those prior services. That would violate 409 Cap A. It can't cover that. Number two, it said, even if that wasn't a problem, there are the anti-acceleration rules that do not permit you to take a substituted payment. Under the terms of the agreement, you had to have a date certain in the future when the payment be made. That would be a payout to come in 10 years, and that's what you originally said the deferral would be. But they said, but you're right to borrow against this, and then just say, instead of repaying the loan, say, forget about it, just charge it against my account. That's a substituted payment arrangement. And as such, that's going to trigger 409 Cap A. So their bottom line, the IRS says this thing doesn't work. Now, my gut is they're probably right, it doesn't work. I do think the key problem here is that the law firm had control of the fee and they just assigned it to a random third party who had nothing to do with the case. I think if the situation was like Child's, where it was the client or the insurance company agreeing to handle the payout and have full liability during the term, well, you know, that would probably be a different kettle of fish. But that's not what we have. We don't have the child's case here. We have the law firm taking $450,000 in cash they could have walked off with. There's no question they could. And simply assigning that to a third party. And like I say, very much that became just like when you when you basically get that $500,000 and say, well, don't give me the cash, but put it into that building, put it into that closing for the building I'm buying. Same difference. So yes, I do think it's highly unlikely this works. Number two, obviously, the IRS, is publishing this and has this nice long memo because apparently they're likely to start challenging these arrangements anyway. So if you do have a law firm who probably isn't a tax law firm, because usually tax law firms, if they're going to do something like this, they do it on their own with their own research and stuff. They're not going to be buying it off the shelf. So it's probably going to be a law firm that doesn't do taxes. You might say, yeah, you really should go get legal counsel of your own and have them look over this and see whether any of this makes sense. And if it doesn't, then don't worry about it. But bottom line, you need to realize that the service has essentially said they're going to challenge you on this. So be aware of that. Finally, want to remind you of one thing here. Well, no, we got this. I remember. We have here the research and experimental expenditures accounting method change procedure. Forgot we have two more things to talk about. This is Revenue Procedure 2023-8, issued on the 12th of December. Now, if you remember right, the Tax Cuts and Jobs Act had a few bad news things, but when you got the law, those bad news things generally are going to happen like years down the line. Don't worry about them. One of those things was going to be under Section 174. 174A allows a business to immediately expense research and experimental expenditures, and it always had since 1954. However, to make their budget numbers work, and I think it was Senator Corker, that was their problem they were having, who has had a very hard line on exact cost. Was it 2.1 trillion, whatever it was, but it had to meet that score. So to meet that score, they designed this provision that require amortization of R&D over 5 years with a mid-year convention for U.S., 15 years of mid-year convention for non-U.S. Now, what that means is your client's research expenditures that last year they could deduct 100% of, this year they're going to have to do it, quote, 5 year with half year convention means they're going to be on a straight line basis. That's going to be only 1/10 of those expenses. So if they, let's say last year had $500,000 of research and experimental expenditures, because they do that in developing products and the other things that Reg 1.174-2 talks about as items that might be in these categories. If they had, let's say, 500,000 of that last year, we would only get to deduct 50,000 this year, and 450,000 would have to go forward into future years for recovery, which means that's probably $450,000 more of taxable income. Not cheap. So again, we required this beginning this year. Now, of course, the theory was at the time that this would never become law. When Congress does stuff like this, it's bad news and it's 5 years down the line. Reality is it's probably never becoming law. You may remember the Cadillac tax from the Affordable Care Act, which was a very similar provision. That was enacted. It made the budget numbers work. So everybody there said, see, we're only spending this much money, right? See, we're only costing us this much money TCJA. But in reality, we all knew that it wasn't ever going to really become law. Except there's now a problem. We've gotten to the due date, and for various reasons, including the failure of the Build Back Better Act last year, which had a huge cost, and this thing was kind of buried in there to fix it, and then followed up by the Inflation Reduction Act this year, which had to come in not only wasn't just it wouldn't spend extra money, it had to come and actually reduce the deficit long term. So there was no way to make that one work, and still get Senator Manchin's vote without, keeping this out. We couldn't fix it. And now the problem is with everybody talking about inflation and worried about, things stoking inflation. Nobody wants to be seen voting for a bill that's going to be scored to increase the deficit. Now, generally, nobody likes this provision. But if you're a Democrat, you're not as concerned about not liking this provision. Why? Mainly because you didn't vote for it. Remember, this was passed on a party line vote back in 2017. That's why I think we're not hearing a lot of complaints about this, except, I mean, you read them in tax circles and you read them in this area, but you don't see people going on TV and talking about this. And the main reason is because, you know, in essence, the ones you would expect to complain about it more traditionally would have been on the Republican side. It's a tax increase, right? Terrible, horrible thing we'd have. But the problem is, most of the people who would go on TV to complain about this voted for it. And that would be pointed out. We've got this because you voted for it. And it was your vote. Okay, here's the roll call vote on TCJ. Your vote, yes. So you voted to do this. Why didn't you get this out of there? And so there'd be a lot of finger pointing. It'd be kind of bad. And so the Democrats are effectively saying, well, if you want this, it's your mess. You need to give us something we want. And therein it becomes a major problem, because what the Democrats want is an extension of the refundable child tax credit. And there are a couple of things Republicans would like to have too in a year-end bill. When you score all of them together, it's about a $700 billion cost over 10 years, which, again, nobody wants to be seen voting to spend $700 billion, increasing the deficits and going, adding to inflation. So unfortunately, this thing that was never intended to become law has a decent chance of becoming law, at least for a while. I still think there's a reasonable chance at some point in time, when the heat's off and they feel they can push this through, and the cost will not be one that will come back to haunt them as to, you voted for this and inflation soared, it was horrible, it's terrible, all those things. So, if we do get inflation under control, who knows? I've given up on trying to figure out what's going to happen anyway. But if inflation was to come down, I wouldn't be surprised to see, if and when that happens, that suddenly this is retroactively fixed. But for now, we got to be ready to make that change. Now, under this revenue procedure, very nicely, the permission is granted automatically if the change is made in the first year it's required, the first year beginning in 2022, as long as you just attach a statement to the return, and the statement details are in the article we have for this week. But you attach a statement to the return with specified details from the revenue procedure. You don't need to have Form 3115. And you don't need to, nothing else there. It'll be a cutoff method, because it's only for things you paid for that were expenses incurred on or after, basically on or after the first day of the first tax year, beginning after December 31st, 2021. So we're just going to do it on a cutoff basis. Now, if you don't do it this year, you get a client who didn't do it, then next year you will need to file a Form 3115, and you'll do a modified 41A adjustment, only going back to capitalize our research experimental expenditures that were incurred on or after the first day of the first tax year, beginning on or after January 1st of 22. That would be your structure in that area. That's how we end up getting this. That's how this whole thing done. Now, the thing to remember, and why you might want to extend these returns, is unfortunately we could be redoing the whole thing if Congress does retroactively change this. You want to keep your eyes on what's happening. Even if they don't solve the problem this week, and it'll probably be this week, if a tax provision is going to get stuck on here, it'll suddenly appear very rapidly next to the spending bill they're going to supposedly work on this week, trying to get out of here for their Christmas break, right? They want to do the Christmas recess, and they ain't missing that. So because of that, we may see something. But if that doesn't happen this week and they let it go into the next Congress, you have to keep your eye on the next Congress, see what's going to happen. And it's a little complicated with next Congress right now, because due to the uncertainty in the House about who will be Speaker, they've stopped actually working on appointing chairs of committees. And apparently there's a nice long line of people that want to be chair of Ways and Means. And chair of Ways and Means would have a huge impact on what happens here. And unfortunately, that probably means the House won't get started doing things for a while. So we could have a very late retroactive fix. Certainly it's not going to be in the first week of the new Congress. I would say probably sometime post regular tax season, if not perhaps even toward the end of next year, depending upon how messed up things get in getting the Ways and Means Committee organized so they could actually do it. Yes, Senate Finance could take the lead. Technically, though, revenue bills are supposed to start in the House, so they'd be playing with some stuff. So, yeah, maybe Senate Finance figures out what to do and waits to find a bill to attach it to. that's possible, but it still seems unlikely the new Congress would fix things on this right away. Finally, the IRS sent a reminder. They're going to remind you this week. This is a news release, IR 2022-220, issued on December 14th. This is entitled IRS Reminders for Many Employers of Self-Employed People, Deferred Social Security Tax Payment Due December 31st. Now, if you remember back in 2020, we had an option for effectively just over 3/4 of the year for employers to elect not to have paid the employer FICA and instead have waited and paid half of it at December 31st of 21 and half of it at December 31st of 22. So they got an interest-free loan through that period. Now, here's the catch. We are certainly approaching that second payment due date. That payment is due by December 31st of 2022. Okay. So it's important to remind your clients about the ways to do it. And this news release tells you all the various ways you could try to make this payment. EFTPS is most likely the way you're going to do it. But if you're a self-employed person, you're looking at the SE tax, you can make the payments via IRS Direct Pay. You can use the credit card option on their website. They do indicate that you could do it via paying with a check or money order, but they send you back to the 941 instructions, which really say you can't do it. But ways that you could try to do it and probably get penalized if you do. But in any event, it is due by the 31st. And the important thing to remember is something we discussed last August, or I should say August of 21. And the big thing that happened in August of 21 was that we discovered in August of 21 that the IRS said if you are a day late or you're $1 short in the amount you should pay, then you have failed to meet the requirements to use the deferral. Having failed, we go back to 2020 and we compute your late payment penalties and apparently interest based on the fact you should have paid these as early as March of 2020, and yet you didn't get around to paying them until January 3rd of 2022. Well, that's late. And you didn't pay. And the other problem is it won't just be this one payment, the second half. It's going to be that first payment you made timely last year, because neither one would qualify for deferral unless you get it right for both. So you want to make very sure that your clients actually are getting these payments in. If you got anybody who did this, get a hold of them now. We still got a little time. It's, basically this is the week of the 19th, but not long. People disappear. Holidays are coming. So make sure you get a hold of them and make sure this payment is done before the end of the year and make sure it is the proper amount. Because again, either one of those penalties could be high. That was if you go back to our article there, which we discussed in the materials, that was basically, as I recall, Program Manager Technical Advice was what was issued in August of 2021 that gave us this news. Well, this has been the current federal tax developments for the week of December 19th, 2022. As always, this is brought to you by Kaplan Financial Education and your state society of CPAs. As you know, if you have any questions, you can email me, edzollers@currentfederaltaxdevelopments.com. I also do follow discussions on some state society websites. The Connect sites for Arizona, New Jersey, Illinois, Washington, Minnesota, I follow there. I also follow discussions on Idaho's discussion, kind of quasi-related discussion board. They don't use the Connect software that other societies are using, but they use their own different structure, so I'm on there as well. You also can find me to some extent. You can watch around and see, where I show up for other discussions, things like that. I'm looking a little bit on Reddit, shall we say, for there, back again to our Tax Pros to see some looks in there and take a look at other places. We are coming up on the holiday season. Not sure how much is going to happen this week in taxes. I'm right now still planning to get something out probably on Tuesday the 27th. Would be the most likely day, right? I think that's, would be the 27th, Tuesday. Since the 25th is Christmas, 26th, therefore, be the day off, 27th is the day you start. So we'd look at that, see if we have anything big, I'll get it there. There's a possibility that things will, timing won't work out. We'll just have to be going later because not much happens into the year. We'll discuss it. Obviously, if we do get a new tax bill, And I think there's at least a reasonable chance we'll get the follow-up to the Secure Act. We'll obviously be talking about that as that comes in. So that's something to watch for too. But otherwise, just tune in. Hopefully we'll be back here next week with something to discuss, maybe a new tax bill, maybe not, or whatever else may happen in the area of current federal tax developments.